Hello, everyone. On behalf of the Councils of Real Estate, welcome to this presentation of the Year in Review, a Fireside Chat. Thank you for joining us. I'm Anthony Delapelle, CRE, 2024 Global Chair of the Councils of Real Estate and Managing Shareholder with the law firm of McCurdy Riskin, Olson, and Delapelle in Northern New Jersey. The Councils of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, councils reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. Let's recognize our 2024 sponsors: Busak Real Estate, Equus Capital Partners, J.P. Wygand and Sons, McCurdy Riskin, Olson and Delapelle, and W.P.J. McCarthy and Company. Thank you all for your support. You're all encouraged to utilize the Q&A feature should you wish to submit a question today. Your participation is welcomed, and we'll answer as many questions as time allows. I'd like to introduce at this time fellow councilors Jonathan Schein, CRE, the CEO and founder of Real Estate Limited Partner Institute in New York, better known as RELPI, and Victor Calanog, Ph.D., CRE, Managing Director and Global Head of Research and Strategy, Real Estate Private Markets from Manulife Investment Management in Boston. Victor is also a member of the Councils of Real Estate's esteemed Economic Advisory Council. Today's conversation promises to be informative, enlightening, entertaining, and because it's Jonathan and Victor, I know there'll be some moments of humor injected as well. Welcome, Jonathan and Victor, and thank you both so very much.
Thank you, Tony, and thank you for a wonderful year of your leadership. It's been a remarkable 2024. Well, welcome, Victor. Good to see you.
Jonathan, it's good to see you. I'm a little bit sad that it was so busy this year that I think I only bumped into you once face to face. Right?
That's exactly right. I'm not at a counselor's meeting, believe it or not.
But at least we bumped into each other once, so that's a great thing. Here we are,
and it's having our fireside chat. I think that's fantastic.
Right.
So,
very serious.
To begin with, first, it's an honor to have you, a person of your stature, to take us home for the 2024. And I'd like to start off with one word. How would you characterize 2024?
One word?
One word.
That's really unfair imposing that on an economist, right? Can I do 2 words?
Okay, I'll give you 3.
3. Okay. Tentative recovery. Is that okay?
That sounds fantastic. And can you actually give us a definition of what a tentative recovery looks like, feels like, can be?
So it's December 12, and I wanted to point to a few things, particularly related to commercial real estate and investments. Number one, if we post increases this year for the whole year, calendar year versus 2023, whether it's in terms of CRE loan originations or transaction activity, that will mean a recovery. That will mean we'll look back as 2023 being the quote-unquote so-called bottom in terms of calendar years. By contrast, coming into 2023, loan originations fell by about 47% versus 2022. Transaction activity based on MSCI RCA's transaction volume numbers fell by 53%. No surprise that it was in parallel. You see credit drying up because of increasing rates, less uptake of loans. There are just less transactions that are going to happen. So what we're looking at could well be a 20 to 25% increase in loan originations for this year versus 2023. And then the latest MSCI RCA numbers aren't out yet, but a quick analysis of seasonality, and there's usually a busier time in Q4 versus other quarters as deals rush to get made. We might be up about 7-10% in terms of transaction activity. And so I consider that, hey, that's a bit of a way up versus 2023, which hopefully we'll look back and that was the quote-unquote bottom.
Well, one of the issues with the recovery, if there is a recovery, because we never know where it's going to go. We just saw another inflation number, what I think it was a 2.7%. One of
Right.
the biggest issues, especially within real estate, are valuations.
Yep.
Where are they? How are you seeing it, not from your own company's perspective, but as a global view? How are you looking at valuations, and are people willing to take that bite yet, or are they still going to extend and pretend?
Well, that's a great question, and of course there are many sides to the so-called elephant. What I'll do is just take a look at and lean on what's called the global real estate performance indices, published jointly by ANREV in the Asia area, INREV in the Europe Asia, and NCREIF over here in the US. So as you know, this is a very specific slice of the institutional investment market. I think NCREIF has about 10,000 properties, right? Depending on who you believe, there are maybe 7 million commercial properties out there. But these are the funds that you typically hear of as being institutional grade. It does look like we're seeing appreciation returns bounce back for the US and for Europe, whereas in Asia, it looks like there's a 4-quarter lag when it comes to realizing losses and marking down values. And so if you believe in leads and lags, it looks like a recovery in values, with the exception of a few property types. Maybe we're going to talk about office in this conversation. How could we not, right? But we are seeing a little bit of a crest upwards in values in the US and Europe, less so for Asia. But then I think from an opportunity perspective, then it becomes, well, if we're still catching a falling knife in Asia, maybe we're a bit too late. You'll hear folks from Blackstone saying, now's the time in the US, right? In Asia, there might well be a little bit more of a wait. So it's very regional and very property specific. And I know that's neither here nor there. But again, fingers crossed that we're turning that corner.
Well, I mean, you did bring up office, so we might as well just start off with
Do it.
office, because I mean
Let's just do it.
that's where
Everything's up after that, right?
everything's up after that. But is then let's talk about office. What are you seeing in office? I mean, TREP just came out with a report that there were about, I think yesterday there were about 200 properties that are actually ripe for conversion to residential. But that makes them no longer office, correct? I mean,
Yeah.
they're office properties,
Yeah,
but does that mean
the
office?
fundamental question I think is once again very regionally oriented, and we're going to back into whether or not the United States slash North America in general is going through more of a secular change as opposed to other parts of the world. Again, I don't mean to keep bringing other parts of the world in this conversation, but the CRE base is global, so I'll give a
Yeah.
heads up with that. By the way, this is a relative non-issue in places like Japan, Singapore, Hong Kong, and a variety of other Asian countries. They are back to 95% plus office occupancies relative to 2019. Very, very hard to track. Whereas I think the US is still mired at around 55%, right? I think in terms of just
That's
physical.
also a regional. That's also a regional. That's a global, a national average, not a regional average.
Yeah, the regional average definitely varies. You've got places that are easier to get to, and you kind of just drive more easily and have great parking. The Southwests, the Southeasts of this world, the Houstons, Dallas of this world, higher utilization rate. Uh, Cities like New York, where it's just, gosh, if I'm going to commute out of the city, still not, don't trust the train schedules fully. Maybe 2, 3 days a week max. So extrapolate from that 50 to 60% utilization, right? I think there's a lot more return to office mandates out there. I'm just not sure or not convinced that that kind of push policy is. I think we've seen this story before, right?
Yes.
I think it's employees 3 versus employers 0 for the past 3 years. Maybe the employers will finally get to it this time around. What do you think? What are you seeing out there, Jonathan?
Well, I'm seeing that nobody likes to talk about office. I mean, that's
Yes.
that nobody likes to talk about it, because as we all heard this story. And frankly, I think the biggest issue, even though the market is making the pricing happen, a lot of the owners and the managers don't quite know how to reprice office
Yep.
yet. It's not out of defiance. It's out of, there has been so little transaction volume in the office market. I mean, it's starting to cook up. And every time, and I'm in the media, I understand media. If a building price is at 40% or 60% of what what it sold for in 2019 or 2020, oh, the sky is falling, it's the end of the office market. So there, but you don't, there's not enough anecdotal evidence to show what is happening in that particular field.
I think what ends up happening is what's typically not reported are a lot of off-market transactions, right? Which may or may not happen. And those have tended to close at much higher percentages relative to the last transaction volume. I'm thinking still a discount, but I'm not surprised. I've seen some in the market closing for 84, 90% of previous transaction price, which is definitely not the sky is falling versus what tends to be reported as 50,
Yeah.
60, 80% off, right? Fire sales. And so I think you're right. I think the way I would describe it as someone with a statistics background is, especially in office, I'd be very, very wary of averages right now. I'd
Yeah.
always take a look at the ranges. But I think the same approach is appropriate for things like cap rates in general. So when you take a look at average cap rates, I think we've started to see a flattening out and even slight declines as early as maybe July of this year. Definitely earlier for multifamily than other property types, right? Does that mean that, oh my God, pricing is anticipated the Fed rate cuts and are now like we're back to an era where we can make deals pencil by assuming that cap rates are going to fall 100 bips. I don't see that in practice. I think a lot of folks are still very conservative. They're hopeful that those trends are representative. But all I'm seeing right now when it comes to actual IC decisions is, well, okay, how does that deal? What will that deal look like if you had to rely only on income returns? Or maybe a 10 basis point decline in cap rates, depending on your entry cap rate. So I think there's still some conservatism out there. Although there are some very, very big players out there saying now's the time to jump back in.
Well, you also have to, that's a good point. You have to talk about who are the buyers of office right now. From what I'm seeing, it's mostly the private investor, the family office, someone with the ultra high net worth. It's not the funds themselves, the institutional grade funds that are really out there scanning the world, unless they can find themselves a sweetheart deal, say, like in 2008 or 9, when I think, which tower was it up in Boston that was,
Oh, right.
I forgot the name. It wasn't I don't think it was Hancock.
It wasn't the Hancock. No, that was our building. So that definitely didn't happen.
Oh, sorry about that. Okay.
Yeah. So yeah.
Too soon. So why don't we actually talk? And I encourage the audience to write in questions. There's a chat or Q&A button there. So as we move along, why don't we really start looking at 25? It's hard to believe that the term "stay alive till 95" is now 30 years old, or even older.
I would love to pretend that I had not heard of that saying before, but unfortunately I have, of course.
And so Sam Zell came up with it in about 1990, which is 35.
SNL crisis. That was the SNL crisis.
If the SNL crisis, if you think about that, there's two generations of real estate professionals that have not seen anything like this kind of downturn, if you want to call it a downturn. So why don't we kind of take a look at that and say, is it good to stay alive? Do we have to stay alive till 25, or is it going to go further than that?
Well, no, if you take a look at just consensus forecasts, and of course that's always slightly dicey when it comes to expectations, because these are, of course, just an aggregation of the crowd. Although I guess I take a look at Rotten Tomatoes too before I watch movies to see what other people think. It does look like from Pension Real Estate Association's latest Q4 consensus survey that they're expecting overall, including total returns across property types, for the NCREIF NPI to return about 6.6% this year, with an acceleration in 2026 to 7.6%, right? Of course, once you break it down by property type, it's still in the red for office. Interestingly enough, retail looks like it's pushing the envelope this time around. Maybe the woes of office has brought the sexy to retail back, just like the great economist Justin Timberlake brought sexy back 18 years ago. Since you mentioned Sam Zell from 35 years ago, I might as well remind people that song came out 18 years ago. Way to make it
I mean, God rest his soul, but I never put Sam Zell and sexy together.
Yeah, but maybe Justin Timberlake
Yeah.
qualifies, right? So
Okay, it does.
retail's quote unquote back, but it's also had 20 years, right, to sort this out. And maybe we're just at that cusp for office. So we're looking at 2025. I don't want this. I never want to listen to webinars where you're like, well, it's just people's opinions, right? So let's take a look at very specific numbers.
Yeah.
Overall, for all property types, PRIA expects that their survey pool of institutional investors will return 6.6%. All equity, right? No layering on debt structure and the like. Office, mostly income, 2.6% up. But if you include appreciation returns, that's still under red. Retail is the leader at 8%. Industrial at 7.6 and resi at around 6.7. Interestingly, I'm not sure I believe that necessarily for residential because what we're expecting for residential is short-term oversupply. Everyone sees that. Everyone expected that. But very quickly, maybe around third quarter of this year, looks like that's going to dry up significantly. 60 to 80% drops in permits, and not a whole lot is getting built in resi, although the train's still moving. So those are
Okay.
very specific total returns numbers, all equity, expectations of investors when they were asked, where do you think NCREIF's NPI is in 2025? Okay.
And why do you see a drop off in residential in the third quarter?
I think it's partly just because resi has sorry, drop off in construction for resi.
Okay, how come?
Right? So there, if you just take a look at leads and lags, if you assume that permits lead actual deliveries by 18 to 24 months, we saw a record amount of permits slash construction opening up maybe 2, 3 years ago.
Okay.
Everyone was expecting anywhere from 800,000 to over 1 million units to come in. It's largely coming to pass. And so that's partly why things are fairly soft for some submarkets, even in the Phoenixes and the Texases of this world, right? But that, in my mind, is a very short term thing. There's still a very systematic lack of supply for housing in the United States. And I know it's partly a political cycle thing. Every so often, just before people get elected, there's always going to be a housing affordability issue brought up. But the truth is, it is beyond electorals. There is, depending on the estimate that you find, 1.5 million to 3 million unit housing shortage in the US, even bigger for the affordable housing space. So in my mind, their demand really outstrips supply, even though in balance this year, there might be some short-term oversupply in some markets.
And you didn't bring up in your statistics industrial. I didn't.
Oh, yeah, no, so I did. We might just have missed it. Industrial was right in the middle. I mentioned that overall it was 6.6.
Yeah.
Office was the lowest at 2.6. Retail was the highest.
Yeah. That we got.
And then industrial is at 7.6%. Again, these are from a great survey that's run by Greg McKinnon at PRIA. So props to him. If you're a PRIA member, you can download it. But just wanted to give him props that this is one of those forward-looking. It's really hard actually to come up with returns forecasts. I'm sure a lot of companies do it internally as we do. But PRIA is one of the few that actually says, hey, we aggregated and this is what our investors appear to expect. Long run might be interesting too. So again, all equity returns 24 to 2028 on average. Retail is still the top of the bucket, 7.3%. The overall number is 6.2%. Office is at 3.5% at the bottom. But resi and industrial and multifamily industrial at 6.6 to 6.9 per year, which I think is not bad. I think overall, when you look at the 10-year trending for this, it's in the 6 to 7 range. So it looks like it's normalizing, if you want to think of it that way.
Okay, so we actually have some really terrific questions coming from the audience, and not all of them are counselors of real estate. Not all of them are counselors of real estate, which is also very exciting. So, but first, any opinion on niche alternative property types? Data centers, cold storage, self-storage. A lot of fund managers such as yourself have a fund just for alternatives, and some of them have funds for just a particular type of property. So what's your take on the alternative property sector?
I do think that in the never-ending quest for yield, if you're taking a look at the core four, a little bit of Schein is off the core four because everyone's in that party, right? And so we've been tracking it. There's a whole lot of data. everyone wants to take a look at alternative sectors. Jonathan, I remember maybe 10, 12 years ago at this point, we started coverage at Moody's and now Reese, it was Reese then, of things like self-storage and student
Right.
housing, because few folks actually covered it on a systematic basis. And there was a reason for that because it was kind of niche at that time. Now it's becoming certainly more it's not mainstream by any means, but it's becoming more of an accepted alternative. Folks are willing to take a look at it. The question then becomes how you execute and how you think about a market where you don't have 10 to 20 years of performance data. If, for
Right.
example, you're looking at a cold storage deal, gosh, in the East Coast, right? How do you size up that market when, by our estimates, 80% of all cold storage inventory out there is obsolete? Meaning, it was a good idea back in the day if you're a warehouse operator and you had a tenant thinking we need refrigerated space, just stick a freezer in there, right? So box in a box, right? Well, the modern tenants these days, I'm talking about pharmaceutical companies that have biologics and vaccines that need 10 to 15 degrees below zero, reliable temperatures that don't go much higher. These need integrated facilities. The newer ones that are built by specialty developers like RL Code are 50, 48 feet high, whereas I think the average assumption for the current inventory right now is something like 20 to 25-foot high ceilings. Again, integrated software and circuitry so that, Jonathan, you can take a look at your goods in the southeast corner of that property and know that they're at this average temperature because these are modern tenants. I think then it becomes an execution and a market by market issue because you can't just download all of this market data from
Right.
pick your data provider, right? CoStar, Moody's, Green Street, and so on and so forth. It's going to be, oh, well, let's talk about execution. Let's talk about the specific deal, if it works. Data centers in general, of course, everyone seems to be really, really hot about that. But then you do it, it's kind of a mix in between infrastructure investments and real estate, right? And tech. It's an operating company. And you have to consider things like in California and other states, there's literally a ton of conversations around energy shortages needed to power these things. So I don't think that's, I'd say, like, handle with care. There is the promise of yield and certainly growth. We've taken a look at data centers in Asia too. Oh my God, that's a whole. You think the conversation around data centers in the United States has a paucity of data issue? Well, think about the conversations you need to have about data centers in the mainland China or Indonesia, and whether outside the main urban areas, right? It becomes a really interesting conversation where I think the less information you have, you're going to have to be willing to go as a GP, for example. You're going to have to be willing to go down the path of, well, maybe we can't do this on our own. Maybe we need to partner up with an opco, a local player that, like, just make sure they have the intelligence and they have the market experience to actually execute on this properly. So I'd say handle with care because it's definitely not as standardized as the data sets that we now take for granted in the core 4 or even core 5. But a lot of promise there, a lot of promise. Absolutely.
Kind of almost what you're saying is a few years ago when everybody was talking about medical office, you're talking about cold storages. They also are intense operating companies. And
They are.
They're not just real estate plays. They're also you're as you said, you possibly need to find that sharpshooter that can help you through.
I mean, let's talk about things like housing subtypes. Senior housing, yeah, maybe, active living is closer to multifamily standard, but you go further up the scale of more and more care needed, things like memory care and skilled nursing, that the economics, the DCF number, the financial models look far more like an operating company to me, right? And by the way, just to relay one of the challenges we had on the data front about that, at least in my past life, the unit mixes are fungible, right? So in senior housing memory care, all you need to do is wheel a bunch of specialized equipment into a room that used to be assisted living, and suddenly it's memory care. So we would cover these properties in senior housing, and you'd think it was as quote unquote fixed as the unit mix of a 238 total units, right? That underwrite 200 2 bedrooms. Except next quarter, it's like 152 bedrooms. because the unit mix changed. Some became assisted living, and then how do you trend out those rents if the unit mix is changing? So it becomes those execution type, deep knowledge type of questions that I think folks just need to be educated about before they make informed investments in these sectors.
Just as we leave the niche strategy
Yeah.
part, 30 years ago, I hate to bring up 30 years ago, Victor, but I'm going to do it.
Let's do
Multifamily was not considered an asset type, an asset class in the institutional investment realm, and now it's one of the leading indicators. So it's just amazing what we'll see, and we're going to get into this in a little bit, what the future holds. Another question: can you speak more to why retail is doing better than other sectors and showing better returns than other sectors, especially in the NPI? We have heard that it's less about demand increasing and more just the lack of quality supply. Haven't we built enough new quality retail space in recent years?
Yeah, that's a great question. And, the problem, it's going to sound super wonky economics here, but what that person is describing is basically an identification problem. In other words, if prices are rising, you don't quite know if it's demand increasing or if because the supply situation is a little bit better. So from a modeling point of view, you really, really need to be careful about identifying which is driving that. Our suspicion, based on what we've taken a look at, is that's right. We can't point to any massive increases in demand in the retail space, which kind of lets you conclude that it must be somewhat limited supply. Not that we haven't been building, we've certainly been building at a very, very moderate pace, but it's also perhaps from a longer term point of view, maybe retail has worked out the issues, the secular change, rise of e-commerce. Do I buy versus Amazon versus brick and mortar that we've talked about over the last 20 years that you brought it up, right? 25 years, maybe at this point. And maybe office is literally just in the first inning. So my suspicion is it's very much a supply side issue for retail. And that's why for the longest time, you've got a lot of retail REITs that were outperforming, even though in general, the media would present retail as the sky is falling, right? So you got retail REITs that were very, very focused, did a great job executing. And of course, they were outperforming. I remember one retail REIT was consistently at 5% vacancies or below, and they had a lot of outlet malls and malls. And we were tracking it on the Moody's Re side, and we were at like 11 to 12% vacancy. So you're like, gosh, it's great that this REIT was at sub 5%, but what about the folks on the other side of the rails, right? Add it up. You're saying there's a bunch of malls there that are on average 20+% vacant? Yeah, actually, yeah. So then it becomes a thing where if what we're recording in NPI are institutional grade investments in the best retail properties out there, then that might explain it too. It's a selection bias thing as opposed to it being the entire market. And again, I think I stated this already. The NPI has, I think, 10,000 properties in its database, and it's tracking pretty consistently for a long, long time. NCREIF's Odyssey, I think, just broke 3,000 properties. So you're looking at a very, very small set, right?
Yeah.
Odyssey being like open and diversified for equity funds. Gosh, that's an even smaller set. So again, I think some people are probably going to ask, oh, these are generalities, right? Yeah, and then let's talk about which part of the elephant we're really looking at here.
Okay.
Yeah.
So another question. Aren't property type generalizations extremely misleading in a very
there you go. I anticipated it, right? Go ahead.
Okay, well, there you go. In a stratified market, isn't the range from A+ office in Manhattan, for example, very much off the generalized norm? Is the stratification more extreme now than in history? Was history like when history was like a rising tide lifts all boats?
No, that's a great question. And my thinking there is this is the way I would answer it. From a demand driver point of view, I think that what's happened to the office sector in particular is we've needed to think very carefully about what actually drives demand for specific cuts of the market, as opposed to the old approach where you're like, we'll just calculate office using employment, right? And then that's if there's more office using employment growth in the Southeast markets as opposed to the Northeast, then we project higher absorption. I don't think you can have that conversation anymore. I think we're back to what I termed earlier as the so-called tyranny of averages, where it's literally just your starting point, right? We do need, all right, rising tide lifts all boats. We're on average, where is that boat, right? But in general, gosh, you look above the tide, below the water, 100 feet below. And I think it's a more meaningful conversation to have a range or a class A plus in
Yeah.
Manhattan's doing great. Fully, if you're one Vanderbilt, you're doing fantastic. But for the rest of the market, gosh, it might be a different conversation entirely. And that's particularly true for the office sector, given what it's going through, I think. But again, that doesn't mean that we're completely sour on the office sector. I think we've gone on the record that we actually were one of the few shops that actually like allowed for construction financing for an office building in Chicago last year. So that's a bet we're strategically taking. And I do think that there are very, very long-term institutional investors out there who, believe it or not, I won't name who they are. They're saying, yeah, this is a short-term blip. We have a 30-year time horizon and we need to deploy large amounts of money. So it's still the office sector that we need to take bets on. It's not that they have their heads in the sand. They're being very smart about it, but it really depends on your horizon and your investment parameter. And to your point, maybe there is that possibility that it's going to be a ground up development to resi for many, many places. I'm a little bit skeptical about that story because, as you know, it's very, very difficult to actually convert existing office space.
Oh, sure.
With floor plates and it's just.
Well, I mean, if Trump comes up with the idea that they came up with 200, right, out of the complete building stock, that's not a lot.
That's
right?
not a whole lot. And
That's
I
not a
bet
lot.
I haven't seen that report and I should because I'm now a Trek client. That's maybe a couple of days ago. I should take a look at that to go and say, is it going to be more common in some markets? Because I always take a look at the Washington, D.C. office buildings because of that lovely.
Well, that's not
building.
exactly a good marker.
It's not the best marker, but in terms of just floor plates and structure,
Oh,
because no
okay.
building there could be built higher or bigger than the Capitol, right? So they tended to be a little bit more squat. You go around DC, and more often than not, the multifamily blendings bleed more into the office buildings, right? Where it's very diametrically different. You walk around New York City's Sixth Avenue, Fifth Avenue office buildings, it looks very different from multifamily buildings, right? So
Sure.
maybe I'd love to see the result and see, oh, maybe certain places are more conducive to such conversions as opposed to there are specialty developers in New York too that's made it
Sure.
a business to convert from office to resi, right? Particularly in the downtown area, the below canal.
I think Van Barton Group is one of those that's been doing a lot of that.
Yeah,
So
and I think there's one shop that's done maybe 22 of them, but
22.
that's over the last 20 years.
Okay.
That's
So one a
still
year.
quite a bit of time frame, right? So again, is it going to be a broad trend? Maybe not. To your point, 200 doesn't sound like a trend to me, but yeah, it's out there. It's one of
It's
the
a rounding error. So, as we move towards 2025, okay, and we have tailwinds, but we also have headwinds. Now, one of the questions that was always asked at a lot of the meetings I've attended, what inning are we in? So right now, in real estate, what inning are we in, or is the game started?
That's a great question. And that's actually been my challenge as a forecaster over the last couple of years, right? And by inning, of course, it's an analogy. It's imperfect. I know we've used it several
What
times.
quarter are we in?
Yeah, what we mean by that is really where are we in the economic cycle, right?
Yes.
And it was almost easier in early 2023 or late 2022 when we were expecting a downturn. You remember that, right? Early
Oh, yes,
2023.
of course.
We have just raised rates. There were folks out there saying that there's a 50% probability of recession. It's heightened. Monetary policy tightening. We're not sure if the US economy will be able to bear it, right? So 50% chance of a recession. I was misquoted, by the way, during that period. Someone said that I was contradicting our chief economist, Mark Zandi, who's a great friend of the Councilors of Real Estate and I respect very much. And some of them said, hey, Victor, you're part of the same organization. You're at Moody's. And Mark's out there saying there's a 50% chance of a recession. You were quoted in the media saying it was 100%. And to Mark's credit, he was really fantastic about it. I literally remember the note he wrote. He said, hey, guys, first of all, we do encourage a multiplicity of well-reasoned opinions in the shop. It's a feature, it's not a bug. He used that term. We're like, yeah, we could differ. We just need to reason it out, right? And secondly, let's just get on the phone because I'm pretty sure Victor was misquoted. And it's true because I said that I was 100% sure there was going to be a recession sometime in the future. How's that for fence sitting, right? Pretty sure there's going to be another recession at some point. I'm just not sure when. And so in 2023, we were at that cusp where it looked like we were looking over a cliff, right? And now it looks like globally speaking, the World Bank is out there saying that GDP growth overall will reaccelerate, okay? After 3 years of slowing down, this being the last year of a global growth slowdown, all right? We're here in the US talking about a soft landing. It looks like a pretty resilient economy, right? So I'm going to answer that question circuitously when it comes to an inning, which is really hard right now to tell. Oh, well, okay. Are we at the bottom going up as an economy? Are we looking at that cusp and our equity markets overpriced? OMG, S&P 500, up 28% for the year. I think the NASDAQ crossed, 20,000 for the first time. So are we going down? Or is it more or less in the middle? Right now, what we're seeing is it looks like that runway is extended, isn't it? Jonathan, let me ask you, as you talk to a lot of LPs, you hear a lot of talk about, oh my God, 2025, we expect a US recession then.
Actually, I'm not hearing that. They are actually, the LPs, the institutional investors are starting to say, okay, the denominator effect is not so much in effect anymore, even though valuations have not been realized, but they still need to allocate a certain amount to real estate. It may be not as much, but some are actually going to allocate more because they took their foot off the gas for 2 years. So they need to get back into the real assets game.
So a lot of them are thinking they might increase their allocations this year just because they, as you said, took their foot off the gas.
You're seeing the same thing. I like it when counselors give us their comments as well, not so much a question, but one said, remember, the number of innings is always a function of weather. All it takes is a rainstorm for a game in the 6th inning to end immediately. Okay. So I don't know if that's optimistic or pessimistic. Let's go for
I'll give the audience something to hang their hats on, right? And it's based on that. You're right. The long-term growth potential of the United States is pegged at around 1.9 to 2%. After all, we're at 28 trillion dollar economy, very, very large, right? So for the most part, for most of this year, I think the 2Q and 3Q numbers were slightly below that, right? And now with all of the revisions and so on and so forth, we might end up at 2.2, 2.4, thereabouts for the year. We'll find out in February. And that is a quote unquote not bad number. Because at 2.2, 2.4, you can take a rainstorm, you can take some kind of idiosyncratic event and probably not be knocked off the rails, right? Yes, I remember when we were at around 1% GDP growth, there was an economist, I forget who basically said, this is just one massive hurricane off Galveston. This is going to knock us off with like the logistics because we were just not growing as fast. But as usual, is it not a balance though? Because a lot of people, I poll people here and some people think, oh, we should grow at 4 or 5%. And I was like, the last time we grew at 5.5% was in 2021. And with that came inflation, right? Yes. So 2 to 3% is kind of that sweet spot where we're toggling between, robust enough economic growth that a rainstorm will not call off the game completely, to extend that analogy. And yet we're not growing so fast that the threat of inflation actually rears its ugly head. Speaking of inflation, you mentioned this earlier, Jonathan. 2.7% was the overall number yesterday, 3.3% for core PCE, right? The core number. And so I'm like, what are you hearing out there about I know you're supposed to be interviewing me, but I think we're having a conversation.
We're having a fireside chat. Look.
Yeah, we are. Let me ask you just real quick. What are your LP partners and clients saying about things like inflation and rate cuts? Are we looking at less rate cuts this coming year? I'll give you a benchmark. I think the Fed's guidance was to go from 450, 475 Maybe we'll end the year at 425, 450, down to maybe 3 next year. So end of next year. So this was before the elections, right? So we're looking at 8 to 9, 25 basis point rate cuts
So
this
you,
year.
you bring up a really what they're saying, and this
Yeah,
is
yeah. I
the
think that
institutional
sentiment has
investor
changed,
side.
right?
This actually comes up to a question that came from the audience and kind of
Okay.
dovetails well. What are the biggest three unknowns for 2025? Which is kind of odd because an unknown is an unknown. But
Yep.
really, the reality is, if these tariffs are actually put in place, if we have a decrease in labor due to
Strict labor policies,
strict
much
labor
stricter
policies,
labor.
what impact will that have on inflation? And
Yep.
it's considered from economists pretty much unanimously that it's an inflationary act. So certainly the tariffs that will absolutely impact whether rates go up or down. And
That's
so
right.
they're kind of holding back and waiting until January 20th to see what actual policies are going to be implemented, and we'll take it from there. That means so they're going to have to really just wait. What they are looking for more right now is returns for basically they're looking for returns over appreciation of value of the real
Yep.
estate. So that's what they're looking at, and that's what they're benchmarking.
Yeah, and I think ultimately that's the question of whether or not some strategies will fly, right? It's, hey, what are the returns going to be? Whether it's alternative sectors, oh, let's go to data centers, oh, let's stick to residential because Victor just said there's going to be a supply issue by later this year. Ultimately, do the numbers pencil? And I think from underwriting point of view, there's still that feeling that, all right, we bake in maybe a slight cap rate decline, but maybe we run scenarios where it doesn't decline because rates remain high and we can't count on that. And now we have to actually pay attention to asset management again and leasing trends, right? Really, income returns haven't 30 to 40% of returns in the last decade before the pandemic been driven by lower and lower cap rates. Maybe those days are over. I think the prudent investors are taking a look at the market saying, you know what? Well, what would the deals look like without big appreciation returns? Does it still make sense? You're taking more corresponding risk if they're development deals, right? And oh, I do have to give some props to the credit side because even as rates decline, given the back and forth between long-term rates right now and short-term rates and all this uncertainty about inflation, I'm not convinced that the attractiveness of things like private real estate credit will suddenly take a dive because now we're easing from a monetary policy point of view. I suspect that that will remain a pretty interesting and viable business moving forward, particularly if the big lenders like banks, which comprise 38% of the CRE pool, remain somewhat on the sidelines. They're not. I know a lot of banking clients, some friends, they're really trying to be strategic about what's out there. But it's also a fact that I think from an originations point of view, private credit has risen from a share of 2.5% in 2009 to about 10% now. And so it's a very, again, bring it back to the global perspective. If you take a look at the US, it's one evidence of how deep and diverse our capital markets are. If only 38% of our commercial real estate financing come from banks, that comparable number is 80% in Asia. It's really still very much driven by corporate loans and big banks over there, with the attendant difficulties for flexibility when it comes to credit. If that's what you need to finance your deal, there's more options in the United States. And that's, I think, a good thing as long as we're prudent about our investments and decisions.
Yeah, and one of the other takeaways from meeting with investors and with managers, and I hope everybody takes this as a nonpartisan approach to what I'm going to say, because it could be either Democrat or Republican.
Yes.
Nobody likes it when one party controls all levers of government, only because things can run amok either way. And so that's just one of the concerns, certainly for overseas investors, is what I've learned as well. They pay attention to our politics more than anyone, and so that's a concern.
That one of the very early on, even before the November elections took place, some of the most comprehensive thought I've seen on this matter are from Ryan Sweet and Bernard Yaros from Oxford Economics, where they did run these scenarios where limited Republican, full Republican, limited Democrat, full Democrat, right? Sweep of everything. And sure enough, it's true. It's the sweeps that worry folks in terms of just overall deficits and debt levels increasing, right? So that's the longer term concern, and we're there right now.
We're
It
there
just
right now, and we're gonna see
just
how it plays out. Hopefully, you always hope for the best.
Yeah, we're hoping for the best, and it's a great question to ask about the tariff policy and what's going to happen there. The complication there is that it is game theoretic, is it not? It depends on the response function of other countries.
Yes.
Maybe we go overboard and countries overreact as well. Maybe we boil the frog a little bit slowly and they don't react as quickly. So it's game theoretic, which means modeling it from a DCF point of view is really, really hard. Good thing I'm actually out of that business right now. Because this is like, oh god, let me now ask Mark and Carl Zandi and their great team of economists. Let me ask the Oxford economics guys what they think. But it's true though. It's a very hard thing to be a forecaster. Right now, it always was.
Yeah.
And now we're looking at somewhat binary things. So you're actually gonna have to model it like option pricing, right? It's not expected values anymore. It's like this branch versus this branch. And then it becomes, you're going to get into things like binomial option pricing and what that means. And it gets very complicated. And then ultimately it's like, gosh, then tomorrow you have to change your model because something changed.
So it's so much easier. Now it's easier for you to just prove an investment thesis versus having to actually make a prediction.
Ultimately, that's what investors care about too, right? It's like,
Yeah,
hey,
exactly.
how much
So
return are we going to get? Yep.
let's just go along this thread of what are the three unknowns that you could think of that could either enhance the recovery that we're in or be basically a headwind.
So I'll because it's unknown, it's almost hard to talk about it. But let me reference a big unknown that I thought was worrisome earlier this year that turned out to be nothing. Okay, not nothing generally, but I thought it was going to be a bigger deal than it actually was. This year represented the largest number of national elections or elections in countries around the world that would imply or potentially imply a change in administration. It was a record high in history. I don't, by my count, it was 70 to 74 countries around the world out of the
Free democratic elections. Free democratic
elections. So let's narrow that down. 8 out of 10 of the world's most populous countries were going to hold elections. Okay. Sure enough, China wasn't part of that because they don't hold elections, right? But
what they did.
Yeah, India, for example, had a lot of Indonesia, very, very high population. And we were wondering about what the Subianto or probable governments were going to do. It happened earlier on. The elections in Romania happened fairly recently. Now, that's a fairly small country, but they're just so happen to be very close to the Russia-Ukraine border. And so, depending on who gets elected there, it might change the geography of whether or not Romania allows NATO presence close by. That could change the dynamics quite a bit. I was paying attention to that, including the US, of course. And in general, would you say that the US elections could have turned out much worse and much more violent than it? I think a lot of people were concerned, right? That, what's going to happen here? Is there going to be a peaceful? And by and large, it looked like most elections represented continuity. That's usually a reassuring thing for investors because you could predict what's going to happen.
Sure.
And, maybe it was really Much Ado About Nothing, which, by the way, was a fantastic 1993 movie starring Keanu Reeves and Denzel Washington.
Yes, and Kate Beckinsale, if I'm not mistaken.
Yes, she was her first on-screen appearance as Hero, if I'm not mistaken. But anyway, maybe it was Much Ado About Nothing. Oh, and by the way, it wasn't strange that Keanu Reeves and Denzel were brothers.
It's a new world, Victor.
Yes, they were a very diverse pick, but as it turns out, because of More
I just want to,
Yes.
I need to clarify something that it didn't just come out in 1993. It was actually written in the 1500s.
Oh,
So
that's right. That's
yeah,
right.
a guy named Shakespeare wrote that. Just want to kind of keep people up to date on some literature. But
Yes. And Jonathan,
get into
you have
movies a little bit.
you have to tell me too. What do you feel about Denzel in Shakespeare? Because I think he's a pretty good actor overall.
I don't like him as a Shakespearean actor. I do like him as an actor. Okay.
This has completely gone off the rails.
Yeah,
Let's
but
bring it back.
let's
We,
bring
we
it
were
back to
we were much ado about not. I was much ado about nothing about the potential geopolitical change, as
yes.
were some pundits. Moving forward, I do want to remind people that there are at least two active wars happening in the Russia-Ukraine area as well as the Middle East, and so we're never quite sure how geopolitics will play out. That's one of the very, very difficult things from an economic forecaster to play out. There are some shops that do this, right? Military forecasting.
Yeah.
They use satellite data to track troop movements across borders. It's really quite fascinating
Do you
field.
use that? Do you use that information when you're tracking for? I mean, do you use that military data seriously? And maybe that would be open up for other investment managers and investors to say, well,
So I track it from a personal point of view, right? From my global remit, I just take a look at where geopolitical uh, fires might flame out or flame up. But right now, it's really hard to apply it necessarily to investment because it's binary, right? It's, oh, everything's fine, and now we're at war, and now it's not fine, right? So
right.
it's like infrastructure investing. Infrastructure is never straight line depreciation, right? It's a bridge is fine, 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 and then there's a pothole, and then cars fall through. And so that's part of what makes. So anytime there's binary choices, it's very that's uncertainty for me.
Okay.
I think it was. I think. Did you know that the equity markets have added about $4 trillion since Trump was elected?
Yes, actually, I
So
know.
it's massive, but I think it's not necessarily ebullience about the administration that came, but the fact that uncertainty was removed. Right?
Yes, that
Now,
is actually one of the big thing the investors were looking for was what is the uncertainty, and as long as there's a clear path of where we're headed, certainty entered the marketplace again, and at least the mindset. And
yeah, and then again, to just I know Tony's back, and I'd love
yeah,
to
talking about coming back. Yeah.
right? I the other source of big uncertainty that turns out to be hopefully much ado about stuff was monetary policy, and it was confirmed that a lot of G7 countries were lowering rates, right? So the Fed actually was about 3 months late, but the ECB just cut rates, right? So it's continuing, it's somewhat coordinated. It will likely follow at different paces because of where we are regionally.
So as we take this home and bring it back to our chair, I'd like to ask Victor, for the sake of the audience and for the holidays, which we wish everybody a happy holiday, what is your favorite holiday movie?
My favorite holiday movie has to be Love Actually from 2003. Just an amazing series of vignettes that come together. And Bill Nighy in that movie was fantastic as the aging rock star Billy Mack. But it wasn't just his story, it was everyone's story. And thanks for reminding me about that, Jonathan. What about you? What's your favorite holiday movie?
Elf.
Elf, of course.
I
My
mean,
kids haven't watched that. I think we
Elf
did.
is wonderful. Tony, as we bring you back, your favorite holiday movie?
Well, I was going to say Home Alone, but how about Bad Santa?
Okay, we can go with that. I mean, we
I have to confess, every time I rewatch Home Alone now, Tony, I take a look at the situation and I go, what does the dad do that they can live in a house like that and bring the entire family right on vacation to France?
Yeah.
That's amazing.
well, it depends on the year. When did it come out? It may not have been real estate.
Yes.
All right. Well, welcome back, Tony.
Thank you. Maybe if you have one, you want to ask one final question of Victor, and then we'll wrap it up so everyone can go on with
Yes.
the rest
Okay.
of the
So,
day.
Victor, moving ahead, what are the tailwinds that are going to bring us forward?
The tailwinds. All right. Number one, general confirmation that economic growth is going to be more robust globally as well as in the US, that has to be a positive. The question then becomes, is it going to come with persistent inflation, and what is the Fed going to do about that? My suspicion is that they might take the foot off the gas of a whole lot of rate cuts. I think a lot of folks are pricing in 4 rate cuts now as opposed to 8 to 9. We will see how it happens, but as we all know, it's the Fed's job to keep us guessing, right? It's literally their job to make sure that we do not anticipate policy moves so that we behave in ways to counteract what they're trying to do. They don't want to tell us they're going to lower rates because we might get so ebullient, so much tailwinds, we increase economic activity, bam, inflation comes back. So they do want to keep us guessing. And that might mean more papers for a nerd like me to write. Definitely keeps things interesting.
All right. Terrific. Thank you, Victor.
Well, thank you both. Thank you, Jonathan and Victor. This has been great. Over the past year, I've heard prognostic themes ranging from stay alive till 25 or take your licks until 26 to T-bills and chill. There are all these, different phrases out there. And I learned when I was very young, majoring in economics as an undergrad. I was told something by a senior when I was a freshman. That was actually when I was still a pre-med, not an economics major. But he said, the only thing that you have to know to learn economics is that you never know. And it stuck with me because he was right. You never know. I mean, people like Victor look at the past and try to predict the future, but you never know. And I think we're in one of those periods where we probably never know more than we used to know. And it's just one of those things. I think looking forward is always difficult, but we're fortunate that we have people like Victor in our organization and other members of our Economic Advisory Council who certainly know a whole lot more about this stuff than me and most of us. So thank you again. Please join us on January 15th for a presentation from select members of our Economic Advisory Council for what's always a compelling hour. You may register at cre.org. And until then, on behalf of the Councils of Real Estate, happy holidays and thank you for attending this session of What's Next for Real Estate and the Life Experience.
Thank you.